Look at the floor of a modern stock exchange. It is a dense, flashing maze of computer monitors, shouting traders, and an avalanche of data. Every single second, algorithms and human brokers execute millions of automated transactions across the globe. This massive digital ecosystem operates with a velocity that defies the human senses. How did this hyper-complex beast actually begin? And what foundational rules still govern all of those flashing numbers today? Beneath all that intimidating digital noise lies a remarkably simple mathematical engine, one that was designed centuries ago. In the 1600s, the Dutch East India Company faced a massive logistical problem. They wanted to send huge galleon ships across the globe to trade for spices and silks, but building and running a fleet of that size required a staggering amount of upfront capital. To solve this, they turned to private citizens. This document is a Dutch manuscript from 1606, and it provides physical proof of their solution. The company took money from everyday people to fund their voyages, offering them a fractional share of the ship's future profits in return. Those citizens soon realized they didn't have to wait months or years for the ships to return. They began trading these physical paper shares with each other at local shipping ports and coffee houses. If you needed cash, you could sell your share of the voyage to someone else. Without realizing it, those merchants drinking coffee on the docks had built a secondary trading market. The massive digital beast we see today is built entirely on that exact premise: everyday citizens sharing the risk of a business to share in its rewards. Let's bring that concept to the present day. Imagine a local coffee company that wants to expand into a massive global chain. Just like the Dutch, they need serious capital to build that infrastructure. First, they pitch the business to large institutional investors. If those big players believe in the vision, they sponsor an initial public offering, or IPO. They inject massive amounts of cash to secure the company's foundation. This officially launches the company onto the public market. The business is divided into millions of tiny, tradable pieces, opening the doors for any individual to buy stock and become a partial owner. That IPO process is the exact modern equivalent of the Dutch galleon launch. It transforms a private ambition into a publicly tradable asset. Once that stock is out in the wild, its price is dictated entirely by a mathematical tug-of-war, the constant seesaw of supply and demand. This animated graph illustrates the positive loop. As a company succeeds and hits its targets, more buyers want to purchase the stock. That increasing demand drives the price upward. But on the same chart, if a company looks less profitable, the reverse happens. Current investors sell to avoid a loss. Supply goes up, demand drops, and the price crashes. When you check a company's real-time market value on your phone, you are simply looking at the exact to-the-second outcome of this mathematical tug-of-war. That seesaw doesn't exist in a vacuum. It is constantly shaken by fluctuating material prices, shifting costs of labor, changing leadership, and new international trade policies. All of these overlapping variables slam into the market at once. They create a dense layer of day-to-day chaotic noise that makes it incredibly difficult to see a company's true long-term value. But the most volatile variable in this entire system is human emotion. Look at this crowd gathered on Wall Street during a historic crash. This panic proves how mass psychology directly overrides logic. Collective fear and greed take the baseline math of supply and demand and violently amplify it. This raw human confidence is what triggers irrational economic booms and severe financial crises. Watching those massive swings happen in real time is terrifying. That sheer unpredictability is exactly what deters many everyday people from ever participating in the market. It is also the exact reason financial professionals promote long-term investing over trying to time the market for quick cash. This visualization shows the power of the macro perspective. When you zoom out and look at the market over a timeline of decades, those terrifying, jagged daily crashes and chaotic peaks flatten out. They get absorbed into a single, steady gold line moving upward alongside general economic progress. True wealth generation requires the discipline to ignore the daily noise and focus entirely on that long-term signal. Global digital networks have dismantled the old barriers to entry. As you can see right here in the palm of a hand, everyday citizens now have the exact same trading access as massive institutional firms. You can use that access to buy fractional shares and directly support the specific companies and technologies that you believe will shape the future. Surviving in this environment requires you to educate yourself, maintain your emotional discipline during the chaotic swings, and stay focused on your long-term goals. The stock market is no longer a closed club reserved for 17th century galleon owners or modern institutional giants. The tools are in your pocket, and the first step is simply getting invested. Subscribe for more deep dives into these market mechanics and start building your own store today.